but because it unfolds slowly, year after year.
It just captures less attention than quick, sudden losses like terrorism, plane crashes, or natural disasters.
Yeah.
I mean, imagine the headlines if you had a Hurricane Katrina 5 times a week, every week. The attention would be immense, right?
Unimaginable.
But even that level of tragedy would not offset the number of annual lives saved by the decline in heart disease. Yet the slow gain gets less focus than the sudden loss.
And this applies to business, markets.
Everywhere. It takes years sometimes to see how important a new company or product is, but failures, they can happen overnight. A stock market falling 40% in 6 months. That gets congressional hearings, endless news coverage.
But a huge gain over several years.
140% gain over 6 years. Might barely register. It just goes unnoticed. So the short sting of pessimism prevails, while the powerful pull of optimism goes unnoticed.
Which really highlights that if you're investing or just thinking long term, you have to understand that volatility and loss are part of the journey towards growth.
Exactly. It's the price of admission for long-term success.
So after unpacking all of this, the intellectual appeal, the financial fear, the slow progress versus fast setbacks, what's the ultimate reason pessimism is so seductive? What's the core payoff?
Well, the source suggests the ultimate psychological payoff is actually quite simple but profound. Pessimism reduces expectations.
Reduces expectations. How so?
It narrows the gap between all the possible outcomes out there and the outcomes you'd actually feel great about. If you expect things to be mediocre or bad, then anything slightly better feels like a win.
Yeah, that makes sense. It reminds me of that incredible story about Stephen Hawking.
Oh, yeah?
When someone asked him if he was always cheerful, despite everything, he said, "My expectations were reduced to 0 when I was 21. That was when he got his diagnosis.
Right. Such a devastating prognosis.
And then he added, "Everything since then has been a bonus."
Wow. That puts it perfectly.
Lowering the bar makes it easier to be pleasantly surprised.
That's the deep irony, isn't it? Expecting things to be bad is the best way to be pleasantly surprised when they're not.
Which, funnily enough...
Which, ironically, is something to be optimistic about.
Huh. Little twist at the end there.
Yeah.
So, okay, wrapping this up, we've seen how our own minds, our biases, the way news is framed, and just the fundamental way growth and setbacks happen. It all conspires to make pessimism feel really powerful, sometimes misleadingly so.
Absolutely. It's a complex mix of factors all pushing in that direction.
So for everyone listening, now that you hopefully understand this seduction of pessimism a bit better, maybe the question to ponder is this: how might knowing this change how you take in the news, how you think about risks, both personal and financial, or even how you approach your own long-term plans and goals?
Yeah, maybe pause and consider that hidden strength of human adaptability we talked about, and that quiet, slow, compounding progress that's always happening. Even if it doesn't make the headlines, it's definitely something worth thinking about.
Welcome to the Deep Dive. We're here to cut through the noise and really get to the heart of important ideas.
That's right. And today, we're tackling something I think is, well, genuinely fascinating.
It's this paradox, isn't it, about how we use history, especially when it comes to money and markets.
Exactly. Yep. History is, fundamentally a story of surprises, things that hadn't happened before.
Right. Events that were totally unprecedented at the time.
Yet, we have this tendency, almost a reflex, to treat it like a roadmap for what's next, like an instruction manual.
It reminds me of that quote from Stanford professor Scott Sagan. He said, "Things that have never happened before happen all the time."
It's such a great quote because it captures the irony perfectly. We want predictability, naturally, especially with our finances.
We look back hoping to find certainty, some kind of guide.
But if history's main lesson is surprise, how can it be a reliable blueprint? The future's bound to have its own shocks.
So our goal in this deep dive is really to help you, the listener, calibrate your thinking on this.
Yeah, help you spot these common pitfalls of using past data and maybe gain a more nuanced view of the future of money.
Without getting totally lost in all the numbers and charts.
Precisely, because that urge for comfort in the past, that leads directly into this trap we're calling the historians as prophets fallacy.
Okay, let's unpack that. The historians as prophets fallacy. What is it really?
It's basically an over-reliance on historical data, thinking it's a clear signal for what's coming next.
Especially in investing, right, where things seem to change so fast.
Exactly. Innovation, change, they're constant, but it's tempting to view investing like, say, geology or medicine.
Ah, okay. Because in those fields, the basic principles are pretty stable over time.
Right. A geologist can study rock formations from millions of years ago and apply those principles today. Doctors know kidneys worked basically the same way 1,000 years ago as they do now.
There's that underlying consistency.
Yes. But investing,
Hmm.
it's just fundamentally different.
How so? Aren't there economic laws or something?
Well, it's driven by people. Millions of people making imperfect decisions with limited information.
And emotions get involved.
Hugely. Nerves, greed, fear, paranoia. Even the smartest people are susceptible. It brings to mind Richard Feynman's famous line.
Oh, the one about physics.
Yeah, imagine how much harder physics would be if electrons had feelings.
Uh-huh. That perfectly captures it. That's investing.
It really is. And it means the foundation of economics isn't stability, it's actually constant change.
Nothing stays great forever. Nothing stays terrible forever. Things shift.
Right. Think of Bill Bonner's analogy of Mr. Market with his capitalism at work t-shirt and a sledgehammer. He's always changing things.
Because what drives it all the stories we tell ourselves, what we want to buy that changes with culture, with generation.
It's always evolving. It never just sits still.
And that constant motion, that unpredictability, that leads to the first big danger you mentioned.
Yes, exactly. The first major danger of leaning too hard on history is that you're very likely to miss the really big shifts, the outlier events.
The game changers, not just small market bumps.
No, we're talking about the truly record-breaking stuff, things that seemed almost impossible before they happened.
Like the Great Depression.
Definitely. Or World War II, the dot-com crash, 9/11, the 2008 housing crisis.
These weren't just blips. They reshaped everything.
They had an absolutely massive, outsized impact because they set off chain reactions, cascading consequences.
It's wild to think about individuals, too. Like, how different would the world be if just a handful of key people never existed?
It's a powerful thought experiment. Take maybe 7 figures from the last century or so. Hitler, Stalin, Mao, Gavrilo Princip.
Yeah.
But also Edison, Bill Gates, Martin Luther King.
Their absence would have created entirely different timelines.
Unquestionably. Billions lived, but the actions of a few had disproportionate global effects.
The same with events, right? Think of the 20th century without, say, World War II.
Or the Great Depression, the Manhattan Project, antibiotics, the internet's precursor, ARPANET, 9/11, the fall of the Soviet Union.
Just a handful of things out of countless events that fundamentally altered the path we're on.
Absolutely, and the compounding effect is often missed. Let's take 9/11 again.
Okay.
19 hijackers. Seems like a specific terrible event, but follow the ripples.
Right.
The Fed cuts rates drastically in response. That fuels the housing boom.
Which then leads to the bubble and the crash in '08.
Exactly. Then you get a terrible job market post-crisis. Millions decide college is the only path forward.
Leading to a huge increase in student borrowing.
And now we have $1.6 trillion in student debt with a default rate over 10%. It's not intuitive to link 19 hijackers to today's student loan crisis, but the chain reaction is there.
It's like that failure of imagination idea Nassim Taleb talks about.
Precisely, like the Egyptians only planning for the worst recorded Nile flood or Fukushima built for the worst past earthquake.
They analyzed the past, but couldn't imagine something worse happening.
Yes. The problem wasn't lack of data, it was a failure to conceive of something truly unprecedented.
So what's the real lesson from surprises then?
Daniel Kahneman put it beautifully. He said the correct lesson isn't, I'll never make that mistake again.
Okay.
It's realizing that the world is surprising. Full stop. It's admitting we really don't know what's next.
We shouldn't use past surprises to define the limits of future ones.
Exactly right. So if you want one prediction that holds up,
What's that?
it's that the next big thing, the event that truly moves the needle for the economy and markets, will likely be something history gives us very little warning about.
Something unprecedented. And because it's unprecedented, we won't be ready.
Which is partly why it has such a big impact. Surprise is the constant mover.
Okay, so that's the danger of missing outliers. What was the second big danger?
The second one is ignoring structural changes. History can be misleading because the underlying systems, the very way the economy and markets work, change over time.
So the context shifts.
Dramatically. Think about your own personal finances. The 401k plan, it's only about 42 years old.
And Roth IRAs came even later, in the 90s.
Right. So how Americans save for retirement today, the advice they get, the analysis, it's not really comparable to what someone faced a generation or two ago. The tools are different.
That makes sense. What about other areas?
Venture capital is a huge one. 25, 30 years ago, it barely existed as an industry.
Really? It seems so dominant now.
It is now, but think of Phil Knight trying to fund Nike early on. He wrote there was no VC back then.
Wow.
So all our historical data on startup fund cycles, failure rates, investment patterns, it's based on a relatively short and very different period. The landscape is completely new.
And even the big public markets like the stock market have changed.
Oh, fundamentally, the S&P 500 index is a good example. Financial stocks weren't even in it until 1976.
I didn't know that.
Now they're a huge chunk. Tech stocks were tiny 50 years ago. Now they dominate.
So all the rules changed too, right? Accounting, disclosures.
Exactly. How companies report earnings, how audits work, how easily you can trade stocks market liquidity, all vastly different.
It seems even basic things like how often recessions happen have changed.
That's another great example. Back in the late 1800s, the U.S. had recessions roughly every couple of years on average.
That often.
Yeah. Early 20th century, it stretched to about 5 years. The last 50 years or so, it's been more like 8 years between them.
And we just had a really long stretch without one recently.
The longest since before the Civil War, actually. Whether it's better economic management by the Fed or the shift from manufacturing to services, the point is the underlying pattern, the structure, has changed.
This makes me think about investment gurus like Benjamin Graham. His book, The Intelligent Investor, is considered a classic.
Absolutely, a foundational text for value investing.
I remember reading it when I was younger, looking at all the historical data.
Yeah.
And his formulas seemed like, a magic key, step-by-step instructions to get rich.
That's the allure, isn't it? Specific rules based on past success. But what happens when you try to apply those specific formulas today?
Well, yeah, that's the thing. A lot of them don't really work anymore, do they?
Often, no. Like his rule about buying stocks for less than their net working assets, or avoiding stocks trading above 1.5 times book value.
Right.
If you strictly followed those today, you'd likely end up owning mostly very distressed companies, or maybe just specific sectors like financials, not quite the diversified path to wealth he intended.
So was Graham wrong or just misunderstood?
He wasn't wrong for his time. He was incredibly successful. But the key, as Jason Zweig pointed out when updating the book, is that Graham himself was constantly adapting.
He didn't stick to the same formulas forever.
Not at all. He was always experimenting, retesting. Zweig noted he'd discard old formulas from previous editions and replace them with new ones. He updated the book 5 times.
He practiced what he preached about analysis, even on his own methods.
Exactly. And near the end of his life, in 1976, someone asked him if his famous detailed stock analysis was still the best approach.
What did he say?
He said, in general, no. He admitted he wasn't an advocate of those elaborate techniques anymore because, and this is his quote, the situation has changed a great deal since then.
He acknowledged the world was different.
Explicitly. He mentioned more analysts, better technology, economic shifts, basically the structural changes we've been talking about. Even the prophet knew his specific prophecies had an expiration date.
It's funny how the further back you look in investing history, the more you're looking at a world that just doesn't exist anymore in the same way.
Which brings us neatly to that phrase everyone loves to mock. It's different this time.
Ah, yes. John Templeton supposedly called those the 4 most dangerous words in investing.
He did, but the irony is Templeton himself admitted that, well, maybe 20% of the time, it is different.
Huh. So even he knew things change.
Right. And those changes are often the most important things to understand. Michael Batnick had a great comeback to that.
What was it?
He said, the 12 most dangerous words in investing are, the 4 most dangerous words in investing are, it's different this time.
That's brilliant. It highlights the danger of automatically dismissing the possibility of real change.
Exactly. So the takeaway isn't ignore history. Not at all.
But use it differently.
Yes. The further back you look, the more general the lessons should be. Focus on the timeless stuff.
Like human psychology, greed, fear.
Precisely. Those don't change much. But specific trends, trades, which sectors are hot, what causes market moves, those are constantly evolving.
So recent history might actually be more relevant for specifics because the underlying structures are more similar to today.
Often, yes. It requires a nuanced approach. History provides context, not a crystal ball.
Okay, so let's pull this together. We've dived deep today and found that history, while valuable, isn't a perfect map for the future.
Right. 2 main reasons. First, the world is shaped by huge, unpredictable outlier events that history can't really prepare us for.
And second, the fundamental structures of the economy and markets are constantly changing, making old data less relevant over time.
So instead of looking to history for a detailed map, Maybe the better approach is cultivating imagination
Imagination for what could happen, rather than just what has happened.
and building resilience, preparing for surprises rather than trying to predict them precisely.
So the question for you, the listener, is this. Knowing that the future will bring surprises, knowing that the ground rules will shift, how do you plan for your financial future?
How do you avoid getting caught in those traps of relying too heavily on past data?
Maybe the answer lies less in forecasting and more in preparing for a world that will always surprise us.
Mhm.
Something to think about.
Welcome to the deep dive. Today, we're taking a deep dive into some really fascinating insights about managing uncertainty, especially, when it comes to our money.
Right.
We've got a fantastic source document here that pulls together lessons from some unexpected places.
Mm-hmm.
Our mission today is basically to pull out the most important nuggets of knowledge from this material. Help you understand how to navigate a world that's less about certainties and much more about probabilities.
Yeah, that's the key, isn't it? Probabilities.
Exactly. And we'll explore why giving yourself room for error isn't some sign of weakness, but actually a powerful strategy for success and, frankly, peace of mind.
It really is.
Okay, let's unpack this. So, here's where it gets really interesting right off the bat. Our source starts by pointing to, well, a pretty unlikely place for smart financial behavior, Las Vegas casinos.
Yeah, not exactly the first place you think of for financial wisdom.
Not the average player, mind you, but a small group of blackjack card counters.
Mm-hmm.
What on earth can a casino floor teach us about managing uncertainty with our money?
Well, what's fascinating here is how these card counters, they really understand probability deeply.
Okay.
They know, like, no one can predict the next card with certainty. It's impossible.
Yeah.
But by tracking the dealt cards, they calculate the odds of the remaining cards.
Right, counting the high and low cards.
Exactly. Then they bet more when the odds are, slightly in their favor and less when they're against them. It just highlights that it's a game of odds, not absolute certainties.
Yeah, so what does this all mean practically? The system works because it slightly tilts the odds from the house to the player, just slightly.
A small edge.
But the key is humility. Even with a statistical edge, like say a 2% edge over the casino still wins almost half the time. 49%, according to the source.
Yeah, that's crucial. You absolutely have to be prepared for those swings of bad luck.
So how do you prepare for that?
Well, this raises that important question. Kevin Lewis, who is a successful card counter, he emphasizes having enough money, enough capital, to withstand those bad swings.
Ah, the bankroll.
Exactly. A rule of thumb he suggests is having at least 100 basic units. So for example, if you start with $10,000, you could maybe comfortably play a $100 unit.
Okay, so you're cushioning yourself against the inevitable losses.
Precisely. It's not about avoiding loss, it's about making sure a loss doesn't wipe you out.
And this idea, this giving yourself room for error, it connects directly to Benjamin Graham's, classic concept of margin of safety.
Absolutely. It's acknowledging that uncertainty and randomness and just plain chance are, well, they're ever-present parts of life, always there.
It's really the only effective way to safely navigate a world governed by odds, not certainties.
And almost everything related to money exists in exactly that kind of world, almost everything.
Yeah.
And if we connect this to the bigger picture, forecasting anything with precision is just incredibly hard. It's obvious to a card counter looking at a deck, right? But it's somehow less obvious to someone asking about, say, stock market returns over the next 10 years, or even setting a retirement date.
We want those definite answers, don't we?
We do. We tend to want black or white answers, but the smart way to proceed is really in that gray area, pursuing things where, a range of potential outcomes are acceptable.
But people underestimate this need for room for error in almost everything they do with money, it seems. Stock analysts give these precise price targets, not ranges. Economic forecasters predict exact GDP figures.
Yeah, down to the decimal point sometimes.
And let's be honest, pundits who speak with that unshakable certainty, they often get bigger followings than those who admit, look, we just can't know for sure.
There's definitely a psychological reason for this. Max Bazerman at Harvard, a psychologist, he showed that people overestimate their ability to accurately predict their own plans.
Oh, interesting. Like my own kitchen renovation?
Exactly. More than they overestimate someone else's renovation plans. It's driven by two things, really. First, that uncomfortable feeling of admitting you don't know the future.
Yeah, nobody likes that.
And second, this sort of perceived harm of not fully exploiting what looks like an accurate view of that future, even if it's probably flawed.
You know, it's commonly seen as like a conservative hedge. Room for error is for people who don't want to take much risk. That's the perception.
Right, the cautious approach.
But our source argues it's actually, well, quite the opposite.
It is, because room for error lets you endure. It lets you withstand a range of potential outcomes. And endurance is just critical.
Why endurance specifically?
Because it lets you stick around long enough for those low probability but really big gains to eventually fall in your favor. The biggest opportunities, the biggest wins, they often happen infrequently, or they take a long time to compound.
You have to be in the game to win the game, basically.
That's it. Think about Bill Gates. He said he wanted enough cash in the bank to pay a year's worth of Microsoft's payroll, even if they got zero payments coming in.
Wow, a whole year. That's a serious buffer.
Or Warren Buffett, pledging to always run Berkshire with more than ample cash. He famously said he will not trade even a night's sleep for the chance of extra profits.
That's room for error in action right there. Big time.
Absolutely. And it's not just about, the cash flow being positive. It's also about mental and emotional endurance.
Ah, okay. Tell me more about that.
Well, think about it. A 30% market decline, that can absolutely shoot your confidence. People quit investing after big losses, often not because they're technically broke,
Right.
but because they're just physically and emotionally exhausted,
Ah,
worn out by the stress and the second guessing.
that's a really powerful point. Spreadsheets, they're great with numbers, but they don't model how you'll feel at 2 a.m. wondering if you made a terrible mistake that's going to hurt your family's future.
Exactly. That gap between what you can technically endure on paper and what's emotionally possible for you, that's a huge, often overlooked version of room for error.
So how does this apply to something like, say, retirement planning?
Well, it applies directly. History shows the U.S. stock market has returned, an annual average of about 6.8% after inflation since the 1870s. That's the long-term number.
Okay, the standard benchmark.
And while that's a reasonable estimate to start with, what if future returns are lower? I mean, significantly lower.
Or what if your retirement date happens to fall right in the middle of a nasty bear market like 2009?
Exactly. Or you just get scared out near the bottom and miss the recovery of the next bull market. Happens all the time.
So this solution, according to our source, it's pretty simple.
It is elegantly simple. Just use room for error when you estimate your future returns. Build in a buffer.
How much buffer, though?
Well, the author admits it's more art than science. For their own personal investments, they assume future returns will be, get this, 1/3 lower than the historical average.
A full third lower. Wow.
Yeah. And because of that assumption, they save more. That's their margin of safety. It lets them sleep well at night.
It reminds me of that Charlie Munger quote, "The best way to achieve felicity is to aim low."
That's it, precisely. It's about setting yourself up so you can still succeed, even if things don't go perfectly according to plan, which they rarely do.
Now, there's a related idea here, isn't there? Something about optimism bias.
Yes, a close cousin of room for error is what the source calls optimism bias in risk-taking. Or maybe more vividly, the Russian roulette should statistically work syndrome.
Okay, that sounds bad.
It is. It's this dangerous attachment to favorable odds when the potential downside is just completely unacceptable. Ruinous.
Right.
Nassim Taleb talks about this. He says, you can be risk-loving and yet completely averse to ruin. And you should be absolutely averse to ruin.
So take risks, but not that risk.
Exactly. The idea is, sure, you have to take risks to get ahead, but no risk that can wipe you out, completely take you off the board, is ever worth taking. The odds are massively in your favor with Russian roulette, right? 5 out of 6.
Statistically, yes.
But the downside isn't just losing. It's total, irreversible ruin. The potential upside doesn't justify it. There's no margin of safety for that.
And the same applies to money. Lots of things usually work out. Real estate prices generally go up. Paychecks usually arrive.
Most of the time.
But if something has, say, a 95% chance of being right, that 5% chance of being wrong means you will experience the downside eventually if you play long enough.
Almost certainly, yeah. The improbable becomes probable over time.
And if the cost of that downside is ruin, the 95% odds just aren't good enough.
Not even close. And leverage, taking on debt to make your money go further, that's often the real devil here, as the source puts it. It pushes routine, maybe even manageable risks into something capable of producing utter ruin. Our sort of rational optimism most of the time can completely mask the odds of ruin some of the time. They just systematically underestimate the real risk involved.
We saw this play out so brutally during the housing crisis, didn't we? Housing prices fell, maybe 30% nationally, and those with high leverage, high mortgages relative to their home value, they faced what the source calls a double wipeout.
Explain that.
Well, not only were they broke, wiped out financially, but being wiped out meant they had absolutely no opportunity to get back in the game when things were cheap.
Ah, right. They couldn't buy low in 2009 or 2010.
Exactly. Homeowners in 2009 who lost their homes, or even huge firms like Lehman Brothers, they were just done. Game over. No chance to recover or capitalize.
So, to navigate this kind of extreme risk, the author thinks of their own money using an interesting analogy. It's barbelled?
Barbelled, like weights.
Yeah, exactly. Imagine a barbell. Heavy weights on each end and almost nothing in the middle. So they take risks with one portion of their money, maybe smaller high-growth bets,
Okay.
and are terrified, extremely conservative, with the other, much larger portion, safe assets.
So very risky and very safe, but not much in between.
Pretty much. It sounds inconsistent, maybe, but it's really about ensuring you can remain standing long enough for your risks, the ones you do take, to potentially pay off. You have to survive to succeed.
That ability to do what you want when you want for as long as you want,
Right.
the source says that has an infinite ROI.
It really does. It's the ultimate goal, isn't it? Freedom and control.
Now, room for error. It does more than just widen the target around what you think might happen. It also helps protect you from things you'd literally never imagine.
Yes, the
Yeah.
unknown unknowns. And these can be the most troublesome events we face precisely because we don't see them coming.
Okay, give me an example.
Well, consider the Battle of Stalingrad. There's this story, maybe apocryphal, maybe not, about a German tank unit being effectively defeated not by enemy fire, but by field mice.
Field mice? Seriously?
Yeah, the story goes they nested in the parked vehicles during winter and ate through the electrical insulation in the wiring harnesses.
No way.
Yeah, that was almost certainly unimaginable to the tank designers back in Germany. You can plan for anti-tank guns, you can plan for mud, but mice eating your wires.
That's wild. You plan for every risk except the things that are too crazy to even cross your mind.
And those crazy things can do the most harm because you have zero preparation for them.
Warren Buffett seemed to get this. In 2006, when looking for his replacement at Berkshire, he said he wanted someone, quote, genetically programmed to recognize and avoid serious risks, including those never before encountered.
Exactly. Not just the known risks, but the ones nobody's seen yet.
The source gives some almost comical modern examples, too, from startups its venture capital firm backed.
Oh yeah. Like what?
Things like water pipes breaking and flooding entire offices, multiple break-ins, getting kicked out of manufacturing plants unexpectedly, a store being shut down by the health department because of a customer's dog.
A dog.
Yeah. Even a CEO's email being spoofed during a really critical fundraising round.
Huh.
Several of these were like existential threats to the companies.
Wow. And none of them were foreseeable.
Right.
Not in any business plan.
Exactly. You just can't predict that level of weirdness. Avoiding these kinds of unknown risks is almost impossible. You can't prepare for what you literally can't envision.
So the key way to guard against their damage, because you can't prevent the event itself, is to avoid single points of failure.
Okay, that makes sense. Don't put all your eggs in one basket.
It's a really good rule of thumb for life, actually. Everything that can break will eventually break. So if many important things rely on one specific thing working perfectly, and that one thing breaks, catastrophe is probably waiting.
Right. Like airplanes having redundant electrical systems, backup hydraulics.
Or suspension bridges being designed so they can lose quite a few cables and still not collapse. It's engineered resilience.
So bringing it back to money, what's the biggest single point of failure there?
For many people, it's probably a sole reliance on their paycheck to cover all their short-term spending needs, with absolutely no savings buffer.
So no gap between income and expenses, living paycheck to paycheck.
Exactly. No gap between what you think your expenses are and what they might suddenly become due to some unforeseen event.
And the trick here, which is often overlooked even by people who are quite wealthy,
Yeah.
is realizing you don't actually need a specific reason to save money.
Go on.
Like saving for a car or a house down payment, that's fine, obvious goals. But it's just as important, maybe more important, to save for the things you can't predict or name yet.
Saving for the unknown.
Exactly. Few financial plans that only prepare for the known risks have enough margin of safety built in to actually survive the chaos of the real world.
You know, in fact, I'd argue the most important part of every plan is planning on your plan not going according to plan.
That's a great way to put it. So, wrapping this up, whether you're a card counter trying to figure out the odds or just, a regular person planning for retirement decades down the line, the lesson seems pretty clear. Humility, acknowledging uncertainty, and deliberately building in that room for error. That can be your greatest asset. It's about constructing a robust foundation for yourself.
It really is. It's about building resilience,
No.
not just financially, but as we discussed, emotionally too.
Yeah.
So you can endure the inevitable bumps and swings of life
Right.
and just stay in the game long enough for the odds eventually to fall in your favor. It's the ultimate long game strategy, really.
So, what really stands out to you from this deep dive? Maybe think about this. How might planning for your plan not going according to plan? How might that change your approach to the future? Definitely something to consider as you go forward.
Okay, let's unpack this. We all know the saying, nothing's free. It's, one of those foundational truths we hear all the time.
Right. Seems straightforward.
But what if the real price isn't just hidden, but like actively disguised? What if you're racking up this massive bill and you don't even realize it until the consequences are kind of staring you in the face?
And what's truly fascinating is how adept we seem to be at overlooking these invisible costs, especially in areas we think are clear-cut, like finance and investing.
Yeah.
We focus so much on the potential returns, the upside, but the true currency of success often demands something completely unexpected from us.
Right. And that's exactly where we're headed today. Our mission is to take a deep dive into understanding these invisible prices.
Get under the surface.
Exactly. We're going to use some incredible real-world stories to make the unseen visible. The goal here is so you can recognize and actually choose to pay the true cost of success.
Because, and this is important, trying to dodge those costs,
Yeah.
it can paradoxically make them even more expensive in the end.
And it might just make you completely rethink your perception of something we commonly call volatility. Okay, so the GE story is a really powerful illustration of those hidden costs in leadership. Immelt's experience really hits home.
It does. But this whole idea of an unseen price, it isn't just stuck in the C-suite, is it?
No, not at all.
It's a constant shadow over our personal finances, too, especially when we talk about investing.
Right. That's probably where most of us feel it.
It truly is. I mean, think about the advice. Hold stocks for the long run. Sounds incredibly simple, right?
Deceptively simple, maybe.
Exactly. Look at the S&P 500, the big U.S. market index. It went up, an astounding 119-fold in the 50 years ending in 2018.
Incredible number.
Looking at that chart, it seems like you just sit back, do nothing, maybe sip a lemonade, and let your money compound effortlessly.
Huh, if only.
But just like running GE, successful investing looks really easy when you're not the one actually doing it, living through it day to day.
That's such a crucial distinction. Reading about returns in a book versus living through the ups and downs. Totally different things.
Day and day.
So if the price isn't just dollars and cents, what is the actual currency of successful investing? What are we really paying with?
Its currency is volatility, fear, doubt, uncertainty, and regret. All those lovely emotions.
Oh, the fun stuff.
Yeah, exactly. And they're all incredibly easy to overlook or underestimate until you're grappling with them in real time. I mean, this raises a really important question. Do you know how hard it truly is to keep that long-term perspective when stocks are collapsing around you, when every headline is screaming doom and gloom?
It's immense pressure.
That's the real price. That emotional turmoil, that's what you pay.
You mentioned an analogy earlier, comparing avoiding this price to shoplifting. Can you expand on that? Because, distinguishing between smart strategies and just trying to get away with something feels key here.
It's a great question. Think about it like this. Say you want a new car. Costs $30,000. You have legit options, right? You can pay for it, maybe finance it. Or you could buy a cheaper used one. That's a valid choice.
Yeah.
Or you could try to steal it. Now, most people don't steal cars because the consequences are glaringly obvious. Prison, fines, huge disruption to your life. It's universally understood as a bad idea.
Right. Very clear downside.
But with the market, it's different. It feels more like a never-ending taunt. It gives you these big returns, making it look easy, then seems to snatch them away just as fast.
Like it's playing games with you.
Exactly. Take the Dow Jones Industrial Average, one of the oldest stock indexes. From 1950 to 2019, it returned about 11% per year on average. That's a fantastic return over decades.
Yeah, absolutely. Most people would happily sign up for 11% a year.
Yeah.
But you're saying there's a catch, a hidden cost to that seemingly steady climb.
Absolutely. The price you paid for that success during that long period was, dreadfully high in terms of emotional strain.
How so?
You can see it in how often the index dropped. It fell at least 5% below its previous all-time high about once every 11 months on average.
Wow, almost yearly dips of 5% or more.
Yeah, it's like getting that new car, but it comes with a built-in feature where it gets dinged every few months. You still own the car, it still works, but man, does it test your patience.
That's a good way to put it.
That is the price of market returns. It's the fee, it's the cost of admission, you could say, and yeah, it hurts when it happens.
And it seems like the bigger the potential returns, the higher this particular kind of price can be. I've heard some absolutely wild examples of this volatility with specific stocks.
Oh, they're almost unbelievable sometimes. Take Netflix. From 2002 to 2018, the stock returned more than 35,000%. Just let that number sink in for a second.
35,000%.
Okay, but here's the price. It traded below its previous all-time high on 94% of the days during that period.
94%. So almost every single day, you felt like you were losing compared to its peak.
Precisely. Even as it delivered those astronomical long-term gains, most days felt like a step back from the top. Or consider Monster Beverage the energy drink company.
Right.
It returned an absolutely mind-blowing 319,000% between 1995 and 2018, one of the highest stock returns in history.
Just staggering numbers.
Yet, it traded below its previous high 95% of the time.
Wow. So these aren't outliers then. This is the nature of high growth.
These are extreme examples, sure, but they illustrate the point vividly. Bigger returns often come with a much higher price in terms of volatility and time spent below previous peaks. So like the car analogy, you basically have a few options in investing.
Okay, what are they?
One, you can pay this price. Accept the volatility, the upheaval, the emotional roller coaster, understanding it's part of the deal for potentially higher returns.
A new car option, dings and all.
Exactly. Two, you can find an asset with less uncertainty and probably a lower payoff. This is like buying the reliable, cheaper used car, think bonds maybe, or very stable dividend stocks. Less exciting perhaps, but less stressful.
Lower price, lower potential reward. Makes sense.
Or option three, you can attempt the investing equivalent of Grand Theft Auto. Try to get the high returns without paying the volatility price that comes along with it.
The steal the car option.
You got it.
And it seems like many investors, quite understandably, go for that third option.
Yeah.
They try to be the car thief investor, right? Devising strategies to sidestep the volatility.
They do. They trade in and out. They try to time the market, sell before the next recession hits, buy just before the next boom takes off.
They know volatility is real. They feel it, so they try to outsmart it, basically.
Exactly. And this is where the futility of trying to avoid the price really becomes clear. There was a study by Morningstar, the investment research firm.
Okay, yeah, I know them.
They looked at something called tactical mutual funds. These funds are specifically designed to do what we just talked about, switch between stocks and bonds at just the right times, aiming for market-like returns, but with lower downside risk.
So they explicitly want the returns without paying the volatility price. The get the reward, skip the pain strategy.
Precisely. The study focused on a period from mid-2010 through late 2011. U.S. stock markets were pretty wild then, lots of ups and downs.
Right, so a perfect test case for these funds. This was exactly the kind of environment where they were supposed to shine, prove their value.
You'd think so. It was their moment.
So how did they actually do? Did they manage to steal the car?
Well, not so much. Out of 112 of these tactical funds during that volatile period, only 9, just 9, had better risk-adjusted returns than a simple, boring 60-40 stock bond fund.
Only 9 out of 112. Wow.
Yeah, and maybe even more telling, less than a quarter of them actually had smaller maximum drawdowns. A drawdown is the biggest drop from a peak value.
So they didn't even protect investors on the downside as well as promised, in most cases.
Largely, no. Morningstar's conclusion was pretty stark. With a few exceptions, these tactical funds generally gained less, were more volatile, or were subject to more downside. They failed on pretty much all counts.
Ouch. So trying to avoid the price actually led to worse outcomes.
Often, yes. And it's not just the big funds struggling with this, right? You see this with individual investors, too.
Oh, absolutely. I can certainly relate to that feeling of dread when the market dips. It's so easy to panic, even when you intellectually know you should hold on.
We all feel it, and the data shows it. The average equity fund investor actually underperformed the very funds they were invested in.
How much by?
By about 0.5% per year, according to Morningstar's research over time.
0.5% a year might not sound huge, but compounded over decades.
It adds up significantly, And it's largely the result of people doing exactly what the tactical funds tried to do, buying and selling reactively, often at the worst times when they really should have just bought and held through the volatility.
So the irony here is just profound. By desperately trying to avoid paying the price of volatility.
Investors actually end up paying double. They miss out on potential long-term gains, and they often incur extra costs through frequent trading or just bad timing. It's a losing game.
That concept of paying double, it brings us back to GE for a moment, doesn't it?
It does.
Because it wasn't just individual investors falling into this trap. Even these corporate giants, sometimes under the banner of smoothness or predictability, tried to avoid paying the true price, only to face a massive reckoning years later.
Yeah, and this goes way back, even to the era of former CEO Jack Welch at GE. He became legendary, right? Almost mythical.
Absolutely. Neutron Jack.
And one reason was his incredible ability to ensure GE's quarterly earnings per share always beat Wall Street estimates. He was a grandmaster at this game. If analysts expected, say, 25 cents per share,
Jack would deliver 26 cents, like clockwork, every single time.
every single time. And how did he do it? Well, behind the scenes, there was quite a bit of, let's call it, massaging the numbers.
Smoothing things out.
Exactly. He would often pull gains from future quarters into the current one to hit those targets. He even wrote about it in his book, how in a pinch, his business leaders would miraculously find an extra $10 million, $20 million, even $30 million from their units to cover any potential earnings gap.
So effectively borrowing from the future to make the present look better.
It was a very clever way to create this powerful illusion of consistent, predictable growth. No surprises.
So under Welch's leadership, stockholders got exactly what many investors crave: consistency and predictability. A stock that just seemed to surge year after year without the messy surprises of uncertainty.
Right. They didn't feel like they were paying the price in real-time volatility. It felt smooth, easy almost.
But, as we've established, the bill always comes due, eventually.
And boy, did it ever for GE. In the years following Welch, GE shareholders suffered through roughly a decade of mammoth losses. Losses that were, in many ways, previously shielded or deferred by those accounting maneuvers.
So the penny gains of Welch's era
Became dime losses later on because the underlying issues, the real volatility and challenges in the businesses were never truly addressed in real time. They were simply papered over, hidden from view.
And it wasn't just GE playing this game, right?
Oh no, not at all. Think about the big mortgage giants, Freddie Mac and Fannie Mae, back in the early 2000s.
Right, before the financial crisis.
They were caught underreporting their current earnings by billions of dollars. And why? Precisely to spread those gains out over future periods.
To create that same illusion of smoothness and predictability.
Exactly. The illusion of getting the rewards without having to pay the price of normal business fluctuations. It never works in the long run.
Okay, so considering everything we've discussed, these hidden costs, GE saga, the investment volatility, the futility of trying to avoid it, it really begs the question, why? Why is it that so many of us who readily pay for everything from cars and houses to food and vacations seem to resist so strongly paying the seemingly invisible price for good investment returns?
It's a great question, and I think the answer is actually quite simple, maybe even psychologically obvious when you break it down.
Okay.
The price of investing success isn't immediately obvious. It's not like a physical price tag you see on a product in a store. There's no sticker on your portfolio saying volatility fee, 10% drop possible this year.
Right. It's hidden, implicit.
So when the bill does come due, when your portfolio value drops significantly, it doesn't feel like a known cost you agreed to pay. It feels like a fine, like a punishment.
Okay. Like a fine for doing something wrong.
Exactly. Think about a traffic fine, or worse, an IRS fine. What does that imply? It implies you messed up, you did something wrong, and now you're being penalized for it.
So the natural reaction is to avoid future fines.
Of course. If you view that market drop as a fine, your instinct is, how do I make sure this never happens again? Which leads to trying to time the market, or selling low, or avoiding stocks altogether, all the things that tend to hurt long-term returns. It's a fundamental psychological reaction.
That distinction is actually crucial, isn't it? It might sound like just semantics, changing a word, but thinking of market volatility as a fee rather than a fine. That seems like a really important part of developing the kind of mindset that lets you stick around long enough for investment gains to actually work in your favor.
It completely changes your perception. It's vital.
Yeah.
I mean, let's be honest, few investors can genuinely say, oh yeah, I'm actually totally fine if I lose 20% of my money. especially newer investors who haven't lived through a major downturn, it sounds abstract until it happens.
For sure.
But if you can start to view that volatility not as a penalty for bad luck or bad timing, but as a fee you pay for the potential of higher long-term returns, things look completely different.
You used the Disneyland analogy earlier, which I thought was great. Can you walk through that again?
Sure. Think about Disneyland tickets. They cost, what, maybe $100, $150 these days? I don't even know, but it's a lot.
Yeah, definitely not cheap.
Right. But millions of people willingly pay that fee every year. Why? Because they anticipate getting something incredibly valuable in return, an awesome day with their kids, memories they'll cherish forever.
They see it as a worthwhile trade-off.
Exactly. No one walks out of Disneyland feeling like that $100 ticket price was a punishment or a fine. They see it as the cost of admission for a great experience. The worthwhile nature of the fee is obvious when it's clear you're paying a fee for something desirable.
And you're saying it's the same logic with investing, just harder to see sometimes.
Precisely. Volatility, the ups and downs, the scary headlines, that is almost always a fee, not a fine. Market returns are never free, and they never will be. They demand you pay a price, just like any other valuable product or service.
And you have a choice.
You do. You're not forced to pay this fee, just like you're not forced to go to Disneyland. You can opt for the local county fair. Maybe the tickets are only $10. Cheaper, maybe still fun.
Or stay home for free.
Or stay home for free, right? Keep your money in cash, perhaps. You might still have a perfectly fine time financially. Maybe you preserve capital, but you'll usually get what you pay for in terms of long-term growth potential.
So the volatility and uncertainty, that's the cost of admission.
That's the cost of admission if you want to access returns potentially greater than those you'd get from lower fee, lower risk options like cash or maybe some bonds. It's the price for playing in the higher return arena.
Okay.
The real trick, the ultimate challenge, is convincing yourself, truly convincing yourself deep down that the market's fee is worth it.
Not just tolerating it, but accepting it.
More than accepting it, actively realizing that it's an admission fee worth paying for the potential long-term rewards. It's the only way to properly deal with the inevitable volatility and uncertainty without letting it derail your plans.
That's a really powerful way to frame it. So what this whole deep dive really boils down to, it seems, is that the most valuable things in life, whether it's leadership success, investment returns, maybe even relationships or skills, they often come with a hidden price. And it's not always monetary. It can involve discomfort, uncertainty, fear, regret, or simply the passage of time enduring difficulty.
Absolutely. And if you truly understand that, if you accept that the greatest rewards often demand a non-obvious fee, well, it raises an important question for you, our listener, to maybe mull over.
Okay, leave us with that final thought.
What areas of your own life thinking beyond just your finances now might be transformed if you could identify and then willingly choose to pay the often hidden costs of what you truly desire?
Welcome to the deep dive. Ever wonder why the experts, the people who seem to have all the answers, sometimes suggest one thing but then do something totally different themselves?
Oh, absolutely.
Well, today we're digging into exactly that. And it kind of starts with this really simple question from billionaire investor Sandy Gottesman. He asks, what do you own and why?
Just that. Sounds basic.
It does, right.
Yeah.
But it actually uncovers this huge, mile-wide gap sometimes between what logic says you should do and what people actually do in their own lives.
Yeah, and that's what we're exploring. This isn't just about financial spreadsheets or anything. It's really about how your own personal values, your unique situation, how that molds your decisions.
Often pushing aside the conventional wisdom.
Exactly. And we'll see why maybe following that personal gut feeling, that unspoken sense of what's right for you, might actually be the smartest way forward.
Okay, so let's pull back the curtain on this disconnect, because it shows up in some really interesting places, like with Sandy Gottesman. When he interviews people for his investment team, he doesn't ask for, market predictions or hot stock tips.
No complex models.
Nope. Just, what do you own and why? He's not after what you think is cheap, based on some analysis. He wants to know what you personally believe in enough to put your own money into. Your actual skin in the game.
Right. Your real commitment. And it's pretty wild how often that commitment seems to be, missing, even where you'd least expect it.
Like where?
Well, there was this Morningstar study. It found that half of all U.S. mutual fund managers don't invest a single penny of their own cash in the funds they actually manage for other people.
Wait, half. That seems I don't know, counterintuitive, almost hypocritical.
It feels that way, doesn't it? But the source suggests maybe it's less about hypocrisy and more just common. This gap between professional advice and personal practice, it happens more than you'd think.
And it's not just finance, right? You see it in other fields too.
Definitely. Think about doctors. There was this really powerful essay back in 2011 by Dr. Ken Murray, How Doctors Die.
Oh, I think I remember hearing about that.
Yeah, he's a professor at USC. And he found that when doctors themselves are facing, the end of life, a terminal illness, they often choose very little medical treatment.
Really? Less than they might recommend?
Often, yeah. They tend to opt for palliative care, comfort, managing symptoms, focusing on, as he put it, going gently, often at home with family. It's quite a contrast to the sometimes very aggressive do-everything approach they might offer patients.
Wow. So why the difference? Why do they choose one path for themselves and maybe suggest another for others?
Well, that really gets to the core of it. For these incredibly complex, deeply emotional issues, end-of-life care, big financial choices, the source argues pretty convincingly that there just isn't one universal truth. There's no single right answer that fits everyone.
Okay, so it's more personal.
It's entirely personal. It's about what works for you, for your family, what lets you feel okay, what helps you sleep at night. These big decisions, they're not just numbers on a page.
They're made around the dinner table, you mean?
Exactly. Often driven by wanting to avoid regret later or protect your family, not just chasing the absolute highest return possible on paper.
So, okay, if that's the case,
Right.
what does financial success really even look like then? Because it sounds like it's not just about piling up the most money.
Precisely. The philosophy we're really digging into today isn't just about getting rich or beating the market. It's something more fundamental. It's the pursuit of independence.
Independence, okay.
Yeah, the legendary investor Charlie Munger, he put it so well. He said, "I did not intend to get rich. I just wanted to get independent."
That's a really interesting shift. It's not about the dollar amount, but the freedom it buys you.
Exactly. The freedom to choose, to control your own life, your own time. That's the real prize.
So independence means what? Like being able to walk away from a job you don't like?
That's a huge part of it. The source defines it as doing only the work you like with people you like at the times you want for as long as you want. And they share this really powerful story about the author's dad. He was an ER doctor, high stress obviously, worked in it for 2 decades, and then one day at age 40, he just quit.
Just like that.
Just like that. Because he could. And that ability, that power to just wake up and decide, okay, I'm changing things starting today, completely on your own terms whenever you feel ready. I mean, that feels like the ultimate financial goal, right?
Yeah, the source called it the grandmother of all financial goals. I like that.
Me too. And here's the kicker.
What's that?
Achieving that kind of freedom, that independence, it doesn't necessarily require a huge income like an ER doctor's.
Really? So how does it work then?
The real driver, the engine behind independence, isn't so much your income level, but your savings rate, how much you're putting away.
Okay, savings rate. Makes sense.
And once you're earning, a decent living, what mostly controls your savings rate isn't getting a raise, it's your ability to keep your lifestyle expectations from constantly inflating, keeping things in check.
Avoiding lifestyle creep.
Exactly. Which leads to this idea they call stopping the goalposts.
Stopping the goalposts.
Yeah. The author and their spouse, they had rising incomes for over 10 years, one in finance, one in healthcare, but they consciously decided to pretty much stick with the same moderate lifestyle they had when they were just starting out.
So, decent apartment, decent car, decent food. Nothing too fancy.
Right. They found it comfortable. They just didn't feel the need to constantly upgrade everything as their paychecks got bigger. They essentially said, okay, this is good enough. Let's stop moving the goalposts for what enough means.
And because they did that.
Because they did that, almost every extra dollar they earned from raises didn't just get absorbed into spending more. It went straight into savings, into their independence fund, as they call it.
So their savings rate just kept going up and up.
Continuously. It wasn't about being stingy. They just weren't particularly motivated by more stuff. Their aspirations kind of plateaued in that area, so they just let the goalposts sit there.
That takes discipline, though.
It does, but think about the psychological benefit. By choosing not to constantly upgrade, you sidestep that whole exhausting game of keeping up with the Joneses.
Yeah, that relentless comparison trap.
Exactly. Nassim Taleb, the author, has this brilliant line: true success is exiting some rat race to modulate one's activities for peace of mind.
Peace of mind. That's a huge win, often totally overlooked.
Enormous. And it frees you up to make decisions that might look, let's say, irrational. if you're only looking at spreadsheets.
Okay, like what kind of decisions?
Well, take their choice to own their house outright, no mortgage.
No mortgage. But interest rates have been so low for ages. Financially, that seems questionable.
Oh, they totally admit it. The source says flat out, on paper, it was probably the worst financial decision they made. Any advisor would say, leverage that cheap debt, invest the difference in stocks for higher returns.
Right. Standard advice.
But for them, it wasn't about the math. It was about feeling secure, independent. Getting rid of that monthly mortgage payment gave them this incredible sense of freedom that they valued way more than potentially higher, but also less certain, investment gains.
So it comes back to that choice. Do you want to be happy, or do you want to be technically right, according to the spreadsheet?
Exactly. And they chose happy or maybe secure. Another example. They keep a really high percentage of their assets in cash.
Cash, like just sitting there.
Yeah, something like 20% of their investable assets outside of their house value, just cash. Which, again, from a pure investment return perspective,
It's hard to defend. You're losing out on potential growth.
totally indefensible on paper, but they don't see it as idle cash losing to inflation. They call it the oxygen of independence.
Oxygen of independence. How so?
Because having that buffer means they are never, ever forced to sell their growth investments, their stocks at a bad time just because some unexpected large expense pops up.
So it protects the long-term investment.
Precisely. It lets the compounding keep working. Remember Charlie Munger again. The first rule of compounding is to never interrupt it unnecessarily. Their bedrock belief is that everyone eventually faces some huge expense they didn't see coming.
A medical bill, job loss, roof caves in.
Something. And that cash reserve makes it much, much more likely they can ride out that storm without having to wreck their long-term investment plan. It lets compounding do its magic over decades.
Okay, so this focus on independence, on sleeping well, on avoiding forced selling. How does that shape their actual investment portfolio? What do they own?
It's led to, well, simplification. The author mentions that back in their 20s, they used to be an active stock picker, holding maybe 25 different individual stocks.
Trying to beat the market.
Yeah, the usual goal. But now they own only low-cost index funds.
It's just index funds,
Yeah.
like S&P 500 trackers.
Pretty much broad U.S. and international index funds. The shift happened because they came to believe that, for most people, trying to pick winning stocks or time, the market is just low odds.
The odds aren't in your favor.
Right. They figure just consistently investing, dollar cost averaging, into a simple, low-cost index fund gives you the highest probability of long-term success.
And the data kind of backs that up, doesn't it?
Yeah, it really does. That stat they mentioned, 85% of large-cap active fund managers failed to beat their benchmark, the S&P 500, over the decade ending in 2019. That's pretty telling.
So it's like trying to become a pro athlete. Some people can do it,
But the odds are stacked against most of us. So why take on the extra risk and effort if a simpler approach works well?
So their current strategy is just straightforward.
Remarkably so. Invest regularly from each paycheck into those broad index funds. Max out retirement accounts like 401ks or IRAs. Contribute to 529 plans for the kids' college savings.
Yeah, that's it. No complex trades, no chasing trends.
That's pretty much the extent of the effort. It comes from this belief that there's actually very little connection between how much effort you put into investing and the results you get.
Really? Less effort can be okay.
They argue yes, because market returns are often driven by tails, meaning a few really big winners or a few major events account for the vast majority of the overall long-term gains. Trying to micromanage constantly doesn't necessarily help you capture those.
So keep it simple, stay consistent, let compounding work, and have that cash buffer for emergencies.
That seems to be the core strategy, because if you can reach all your financial goals, achieve that independence, without the stress and risk of trying to outperform everyone else, why wouldn't you?
Makes sense. The ultimate goal isn't beating the market.
Nope. The ultimate goal is independence. It's maximizing your ability to sleep well at night. And that, they argue, is the real mastery of the psychology of money.
Wow. So this whole deep dive really drives home that there isn't just one right way to handle your money or your life, really.
Absolutely not. We saw it with Gottsman's question, with the doctor's personal choices, with this family focusing squarely on independence. It's all about how deeply personal values and priorities shape everything.
Yeah, the path to feeling financially secure, it isn't always about chasing every last dollar or maximizing returns on paper.
Often, maybe more often, it's about finding what genuinely gives you peace of mind. What allows you to live life on your own terms.
It comes back to that quote from the source. No one is crazy. People do things that make sense to them, given their own experiences and goals.
Exactly. So, as we wrap up, maybe the question for you listening is, what really stood out to you from this look at the psychology of money? And how might your own definition of financial success, your own path, look different from what the traditional advice might say? Welcome to another deep dive. Today, we're plunging into a topic that really touches everyone: how we navigate financial decisions. We often look for the right answers, don't we? But what if, maybe, the best approach comes from somewhere totally unexpected, like, say, medicine? Yeah, we've got some really fascinating material here for this deep dive. Excerpts from a text that, well, it promises to tie together key lessons for making better financial choices. So our mission today is to unpack these insights for you. And we're going to focus particularly on this surprising historical story that really illustrates the dangers of just being told what to do, especially with your personal journey.
It's really compelling, actually, how this source kicks off with something that seems totally unrelated, an old anecdote. But it just perfectly sets the stage for this critical discussion about autonomy, about decision-making, and what it actually means to be well-informed, whether that's health or finance.
Okay, let's get into it then. Because to really get the author's point, we need to go back, way back, to 1931, and specifically to a dentist appointment that just went horribly tragically wrong. So picture this. 1931, a man, Clarence Hughes, he's in agony, terrible toothache. He goes to the dentist. The dentist uses what they called back then crude anesthesia. So Clarence wakes up hours later. The toothache is gone, sure, but he finds out he's also missing 16 teeth. And kind of randomly, his tonsils are gone too.
Wow.
Yeah. And then the real tragedy hits. A week later, Clarence dies from complications. From that, extensive surgery he never actually asked for.
And you'd think, okay, medical malpractice lawsuit, right? But his wife's lawsuit wasn't really about that. It was about something, well, more fundamental: lack of consent. Her point wasn't that the surgery itself failed. I mean, that was a risk back then, a known risk. It was that Clarence never agreed to have 16 teeth pulled or his tonsils out, and probably wouldn't have if he'd been conscious and asked.
And the legal side of things in 1931, well, it was pretty murky on this. Consent wasn't exactly clear-cut. The case didn't really go anywhere. And one court ruling sort of summed up the thinking at the time. It said doctors needed, quote, freedom to make the best medical decisions.
Right.
And get this, it added, without such, we could not enjoy the advancement of science.
That ruling,
Yeah.
it really shows you the mindset, doesn't it? The historical medical thinking. For like most of history, the doctor's job was just seen as fix the patient. Simple as that. What the patient actually thought about the treatment. Often totally irrelevant. And, it wasn't necessarily doctors being arrogant or malicious. It came from this really deep belief in two things. First, every patient wants to be cured. Okay, seems reasonable. And second, there is a universal and right way to cure them. Now, if you truly believe both those things, then minimizing patient consent, well, it actually follows a certain, albeit strange logic. Sounds jarring now, but back then.
But that's obviously not how medicine works today, thankfully. And the source material we're looking at uses this shift beautifully. There's been this maybe subtle but really profound change in medical schools over the last, say, 50 years. They've moved from just treating the disease toward treating the patient. And that means something fundamental changed. Doctors started laying out the options, explaining the choices. And then, this is the key part, letting the patient decide which way to go.
Yeah, and that massive shift was driven by a few things. New patient protection laws played a part for sure, but also the really influential work of a Dr. J. Katz. Katz argued very powerfully that patients, well, they have wildly different views about what's worth it in medicine. What's an acceptable risk for you might be totally unacceptable for someone else, right? Different values, different life situations. So their beliefs, their personal context, it has to be part of the decision.
Yeah, Katz had this quote. It's really powerful. Gets right to the core of it. He said, "It is dangerous nonsense to assert that physicians can rely on their benevolent intentions, their abilities to judge what is the right thing to do. It is not that easy. Medicine is a complex profession, and the interactions between physicians and patients are also complex." That last bit. Interactions between physicians and patients are also complex. That feels incredibly important, don't you think?
Absolutely. It's not just the science.
Right. It's the human element.
Exactly. It means even if a doctor means well, their judgment can't just override the patient's autonomy, because only the patient really knows what's worth it for them. And this wisdom from medicine, this focus on the individual, it maps so perfectly onto financial advice. Just like a good modern doctor doesn't just dictate treatment, the author of our source material says, look, I'm not going to tell you exactly what to do with your money. They explicitly avoid treating you like that dentist treated Clarence Hughes.
And that distinction is just crucial. It's not saying doctors or financial advisors are useless now. Not at all.
Yeah.
They have huge amounts of knowledge. They know the odds. They know what generally works for most people most of the time. But at the end of the day, you, the individual, you have to decide what's right for your specific, unique situation. Like our source says, there are universal truths in money, sure, but people will apply them differently. And they should apply them differently, based on their own goals, their values, their circumstances.
Okay, so with that kind of groundwork laid, this idea of autonomy and context, our source then gives us a series of short recommendations. But they're not rules, not prescriptions. Think of them more like guideposts, really helpful ones. They're designed to help you navigate your financial life, respecting all that complexity we just talked about. Just like a good doctor helps you choose your treatment.
Right. So let's dive into these guideposts. The first one that really jumped out at me, and maybe it sounds a bit, I don't know, counterintuitive, it's humility and forgiveness. The author says you need to really make an effort to find humility when things go right and offer forgiveness or compassion when they go wrong, because they say it's never as good or as bad as it looks.
Absolutely. And it's not just about, being nice to yourself, although that's part of it. It's about really understanding that outcomes, well, they're a mix, aren't they? Your effort, your skill, sure, but also just chance, randomness, luck, and risk. So things go well. Okay, maybe it wasn't all you. Things go badly. Probably not entirely your fault either. Understanding that helps you avoid getting overconfident when you win and beating yourself up too much when you lose, which is, essential for staying sane long term.
That's such a critical point. It changes how you judge yourself, sure, but also how you judge others and who you pick as role models.
Yeah.
Which kind of leads into another big one, less ego, more wealth. The author puts it bluntly, saving money is the gap between your ego and your income. What do you make of that?
Oh, it's spot on. Because wealth itself, often it's the money you don't spend. It's built by resisting the urge to buy something today so you have more options or more security later on. We tend to think wealth is the fancy car, the big house, the stuff we see.
Yeah, the visible stuff.
Exactly. But true wealth is often quiet, invisible. It's accumulated savings, investments. It's about delaying gratification, prioritizing the future over showing off now. It doesn't matter how much you earn, really. If you can't manage that gap between your income and your ego, you won't build lasting wealth.
That really drives it home. Wealth isn't just a number, it's a behavior, a mindset. And speaking of mindset, here's a great guidepost. Manage your money in a way that helps you sleep at night, which is very different from just saying get the absolute highest returns possible, isn't it?
Totally different, yeah. A lot of finance advice focuses purely on maximizing returns.
Yeah.
But this source suggests that prioritizing your peace of mind, that might actually be the best universal guidepost for everyone. It just acknowledges that we're all different. Different risk tolerance, different life stages, different emotional reactions to money swings. If your financial plan keeps you up at night, worrying constantly, even if it looks great on paper, it's probably not the right plan for you. It goes back to treating the patient, not just the numbers.
Makes perfect sense. Your finances should support your life, not cause constant stress. Okay, and for investors specifically, the author highlights the single most powerful tool they have, increase your time horizon.
Time. It really is the magic ingredient in investing, isn't it? It lets compounding work its wonders, turning small amounts into bigger ones. And just as importantly, it smooths out the bumps. Big mistakes. They tend to fade in importance over decades. Market crashes. You have time to recover. The longer you stay invested, the more your results tend to move closer towards what people deserve, meaning closer to the market's long-term average growth. It irons out the volatility.
Gives good decisions time to pay off and bad ones less impact.
Exactly.
Which is a nice segue to another key piece of advice. Be okay with a lot of things going wrong. The source says you can actually be wrong half the time and still make a fortune. How does that work?
Well, it's because in finance, especially in investing, outcomes aren't evenly distributed. It's often what they call a power law or Pareto principle. A small number of things drive the majority of the results. Think about venture capital.
Right, they expect most investments to fail.
Yeah, they might have tons of investments that go nowhere or even lose money, but one or two huge winners, Google and Amazon, can make the entire portfolio incredibly successful. So, the lesson is, judge your overall performance, your full portfolio, not individual bets. Fixating on single stocks or single decisions can lead you astray. You might ditch a strategy too soon or think one lucky pick makes you a genius.
It's about the overall average and surviving the inevitable losers to benefit from the big winners.
Precisely. You have to endure the bad to capture the good.
Enduring. That connects perfectly to the next idea. Worship room for error, this gap between what could happen
Yeah.
and what you need to happen. That's how you endure, right?
It's such a crucial concept, and maybe a bit counterintuitive again. Our instinct is often to push things to the limit, optimize everything for maximum gain.
Yeah, squeeze out every last drop.
This guidepost says, no, hold back a bit. Build in a buffer, room for error, having savings beyond your immediate needs, not being fully leveraged. Having flexibility might look like you're being too conservative, like a hedge that costs you potential gains. But it's what keeps you in the game when the unexpected happens. A job loss, a market crash, a global pandemic, whatever life throws at you. And staying in the game is how you let that compounding magic happen over the long run.
Yeah.
So that buffer pays for itself many, many times over. It's not just caution, it's strategic endurance.
I love that framing. Endurance, not just caution. It changes how you think about it. Okay, and then the author wraps up with a couple of ideas that bring it right back to that personal context we started with. Define your game and respect the mess.
Yeah, these are so important for navigating the real world of money. Define your game means understanding your goals, your time horizon, your risk tolerance, and crucially, making sure your actions are not being influenced by people playing a different game.
Oh, that's huge today with social media and everything, seeing people flashing cash or hyping stocks.
Exactly. It's so easy to get caught up in what others are doing. FOMO, right?
Yeah.
Fear of missing out. But if that person is, say, a day trader playing with money they can afford to lose, you're saving for retirement in 20 years. You're playing totally different games. Following their moves could be disastrous for you.
Right. You need blinders, almost. Focus on your own path.
And then respect the mess. This acknowledges that even smart, well-informed, reasonable people can look at the same financial situation and come to completely different conclusions.
Why?
Because, as the source says, people have vastly different goals and desires. What's right for one person is wrong for another. So, there often isn't one single right answer in finance. Accepting that messiness leads to less judgment, both of others and yourself, and probably more effective playing for your own situation.
Wow. Okay, this has been a really, really illuminating deep dive. It shows the financial wisdom. It's not just about the numbers, is it? It's so deeply tied into understanding ourselves, human behavior, our values, even these big historical shifts in how experts think.
Absolutely. And if you connect it all back, that journey in medicine, from a doctor just telling a passive patient what to do to a doctor collaborating with an informed patient, that journey really mirrors the path we should be taking in finance. It's about knowing the general principles, the universal truths, sure, but always, always applying them with a deep respect for your own individual context, your own specific goals.
Which brings us nicely to our final thought for you, the listener, to maybe chew on. In this world that's just overflowing with financial advice, how do you actively, consciously define the game you're playing? And how do you make sure your decisions truly line up with your goals, your desires as they are now and as they might change, rather than just following someone else's playbook?
And building on that, maybe ask yourself this: how can you intentionally cultivate that room for error in your own financial life? Not seeing it as, just being overly cautious or missing out, but embracing it as the actual foundation. The thing that gives you endurance, the thing that lets that long-term compounding magic truly work for you.
Lots to think about there. Thank you for joining us on this deep dive. Until next time, keep digging for those insights. Okay, imagine this for a second. You fall asleep in, say, 1945. Then you wake up in 2020.
Whoa.
Right. I mean, the shock would be incredible. You'd see this staggering wealth in places like New York, San Francisco, but then, devastating poverty in Detroit, and the prices, homes, college, healthcare. It would make absolutely no sense.
Yeah.
And maybe the biggest thing, how average folks think about money, saving, spending. Totally different from back then.
Yeah.
And I bet any story you try to tell yourself about how we got from A to B, it'd probably be wrong. You just couldn't have predicted it. So, yeah, how did we get here?
That really is the essential question, isn't it? If you want to understand the modern consumer's mindset, even get a handle on where the economy might go next, you really have to trace that journey back.
Okay.
So that's what this deep dive is about. We're going to explore the story, the narrative of the American consumer, really starting right after World War II. We'll link the big events, try to show why we think about money the way we do today.
And why those ideas are so sticky, maybe.
Exactly. Why they're so hard to shake off, even when things change.
All right, let's do it. So we start August 1945. Japan surrenders. New York Times calls it the happiest day in American history. Just pure joy everywhere.
Absolutely. Parades, celebrations.
But then, once the cheering stops, this big question mark starts hanging in the air. What happens now?
And that wasn't just a casual question. It was loaded with anxiety. For policymakers, for regular Americans, everyone.
Because the scale was just enormous.
Think about it. 16 million Americans served. Yeah. That's like 11% of the whole population then.
Wow.
8 million were still overseas when the war ended. And almost all of them, barring maybe 1.5 million, were going to be home at a uniform within 18 months.
So the immediate fear was...
Three huge things. Where are they going to live?
Right.
And what jobs they're going to do.
Right.
A lot of people, smart people, economists, genuinely thought, here we go again. Back to the Great Depression. Which, remember, had only really ended 5 years before. That fear was palpable.
And you can imagine, with that depression shadow looming, policymakers must have felt immense pressure. What were the specific things staring them in the face, like the concrete problems?
Well, for starters, housing. Construction basically stopped during the war. Everything went to the military effort.
Sure.
In 1943, they were building fewer than 12,000 homes a month. That's nothing. So GI's coming home. Massive housing shortage.
Okay, so that's shelter. What about work?
Millions of jobs have been created just for the war. Building ships, tanks, planes, highly specialized stuff.
Right.
And those industries, they shut down almost overnight. Boom. Gone. Not like a normal business cycle downturn.
So policymakers were genuinely worried.
Deeply. The Council of Economic Advisors wrote a report for President Truman in '46 warning of, quote, a full-scale depression.
Wow.
There's another memo from '47 summarizing a meeting with Truman talking about the danger of a downward spiral.
And they couldn't just, export their way out of it?
Not easily. Europe's economy was wrecked. Japan's too. So export markets weren't there. And America itself. Record levels of debt from the war. So massive government stimulus wasn't really an option either.
Okay, so faced with this potentially catastrophic situation, what did they do? What levers did they pull?
This is where it gets really interesting. You see this very deliberate policy choice emerge. Keep interest rates incredibly low.
How low?
Well, the Fed had announced back in '42 during the war that they'd keep short-term rates pegged at 0.38% to help finance the war, right?
0.38. That's basically zero.
Pretty much. And here's the kicker.
Yeah.
Those rates didn't move for 7 years.
7 years.
Yep. 3-month Treasury yield stayed under 2% all the way until the mid-1950s.
So was that just inertia from the war financing, or did they realize, hey, this cheap money could be useful?
That's the key point.
Yeah.
It started as war finance, but it quickly became clear that these rock-bottom rates made borrowing super cheap for houses, for cars, for all the new gadgets people wanted.
So it became a strategy.
An explicit economic strategy, yeah. The historian Sheldon Garin talks about this shift. We went from this wartime culture of save, 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 buy war bonds to actively encouraging people to spend. Cheap borrowing was the engine.
And there were two huge things that really poured fuel on that fire, right?
Absolutely. First, the GI Bill. Just transformative.
How so?
It gave those 16 million veterans access to mortgages like never before. Often, zero money down, no interest for the first year, fixed rates so low your mortgage payment could actually be less than rent.
Unbelievable. And the second thing?
An explosion in consumer credit. They started loosening the regulations that had been put in place during the Depression.
Okay.
You get the first real credit card, Diners Club, in 1950. Then store credit, installment plans, personal loans, payday loans. It all just took off.
And you mentioned a crucial detail before about taxes.
Right. Until 1986, the interest on all debt, including your credit card debt, was tax deductible.
Seriously?
Seriously. Think about the incentive that creates to borrow and spend. It's baked right into the tax code for decades.
Okay, so that really sets the stage. You've got cheap money, easy credit, and after the war, all this pent-up demand. People hadn't been able to buy stuff for years.
Exactly. Factories were making tanks, not toasters.
Yeah.
So households were starved for goods.
Were there other factors boosting this spending wave?
Yeah, there was this sort of hidden productivity gain that came out of the Depression.
How does that work? Hard times make you more productive.
In a way, yeah. The 1930s, tough as they were, forced incredible resourcefulness, efficiency, innovation, just to survive.
I see.
So you had all these advancements bubbling under the surface, better appliances, cars, phones, air conditioning, wider electricity access. It wasn't obvious during the Depression or the war, but by the 50s, America realized, hey, we're actually really good at making stuff now. We've got all these cool new things to make.
And people just went on a massive shopping spree.
Colossal. Give you some numbers. Commercial car and truck production. Basically zero from 42 to 45.
Right?
Then, between 45 and 49, 21 million sold. Another 37 million by 1955.
Whoa! And houses.
Same story. Fewer than 2 million built between 40 and 45. Then, 7 million from 45 to 50. Another 8 million by 1955.
It's hard to even picture that scale of building and buying. It's not just economics. It's like the physical landscape of the country changing.
Completely. And think about the jobs. All those returning GIs needed work. What did they do? They got jobs making all this new stuff.
Right.
And they earned good money doing it.
Oh.
The Fed told Truman in 51 that by 1950, consumer spending in home building hit $203 billion. That's about 40% higher than the peak of the war effort in 44.
So the answer to what will the GIs do was basically they'll build the suburbs, fill them with stuff, and buy cars to drive between them.
Pretty much. They were buying stuff with money earned, making new stuff, often helped by cheap loans to buy even more stuff. It was a powerful cycle.
So this post-war boom takes off. What was the kind of social vibe? Was everyone getting rich, or was it uneven?
You know, what's really remarkable about that period, roughly 1950 to 1980, is how much the country got richer together.
Shared prosperity. You hear that term a lot.
And it was real then. The gap between the rich and the poor actually narrowed significantly.
How so?
Well, look at the top 1% share of national income. After taxes, it fell from about 13% down to 7% by 1945. And get this, from 1950 to 1980, the real income growth for the bottom 20% of earners was almost identical to the growth for the top 5%.
That's incredible. So people really felt like they were moving up together.
Exactly. And it wasn't just income. It was social leveling, too. Women entered the workforce in much greater numbers. Participation went from 31% after the war to 40% by 1965.
Ever.
Minorities saw gains, too. Eleanor Roosevelt wrote about seeing an African-American reporter at a White House reception in 1945 mixing easily, something she said would have been unthinkable just 12 years earlier.
And lifestyles became more similar.
Yeah, Harper's Magazine wrote in 57 something like, the rich man smokes the same cigarettes as the poor man, uses the same razor. There was this sense of shared experience. But Paul Graham made a great point years later about TV. Back then, there were basically 3 networks. So every night, tens of millions of families, neighbors, were watching the same shows, laughing at the same jokes. What we see now only with the Super Bowl. That used to happen every night. We were literally, as he put it, in sync.
That's a powerful image. And it matters, right? Because we judge our own well-being by looking at the people around us.
Absolutely crucial. For most of that 45 to 80 period, most people saw their neighbors, their co-workers, living lives that felt, similar, or at least understandable, relatable, not wildly different.
So with all this shared growth, how did debt fit in? Were people still scared of it after the Depression?
You'd think so, but no. Household debt actually surged. It increased 5-fold between 1947 and 1957.
Wow. Why?
Well, that new consumer culture we talked about.
Yeah.
All the new things to buy. Plus, all those new ways to borrow money, credit cards, installment plans, and crucially, those super low interest rates, often subsidized.
But didn't cause problems.
Largely, no. Not then. Because incomes were rising so strongly across the board, people could handle the payments. And remember, people started from a very low base of debt. The Depression wiped a lot out, and wartime rationing and saving had kept borrowing down.
So debt was rising, but income was rising too.
Exactly. Even with that 5-fold increase, the overall household debt-to-income ratio stayed below 60% right up until the late 1970s.
Which is way lower than today.
Oh, much lower. Today it's over 100%, and a lot of that debt was going into homes. The homeownership rate just took off. It was 53% by 45, hit 62% by 1970. Millions became homeowners who couldn't have before.
So this generation just had a different attitude towards debt.
Completely different from their parents.
Yeah.
David Halberstam wrote about this in his book, The 50s. He said they were confident, optimistic. They didn't fear debt like the generation that lived through the Depression. They felt like, the good times were here to stay. The future had already arrived, as he put it.
It sounds like a golden age in a way. America booming, doing it together, debt manageable, but obviously it didn't last forever.
No. The story definitely takes a turn. Around 1973, you start seeing the cracks appear.
What happened in 73?
Well, a recession hit, and it was nasty. Unemployment shot up to levels not seen since the Depression. Inflation, which had been around, suddenly surged and just stuck around. It became persistent.
Stagflation.
Exactly. And interest rates started climbing too. Short-term rates hit 8% in 73. Remember, they were down around 2.5% just 10 years earlier.
And this wasn't happening in a vacuum, right? There was other stuff going
A
on.
lot of other stuff. The hangover from Vietnam,
Right.
riots in cities,
Hmm.
the assassinations of the king, the Kennedys. There was a sense of unease, instability.
Plus, America wasn't the only economic game in town anymore.
Right. Japan's economy was booming, becoming a real competitor. China was starting to open up. The Middle East realized the power it had with oil. The oil embargo hit in 73 too. America's unquestioned economic dominance started to fade.
So those post-war tailwinds were dying down. The economic ride got bumpier.
It got uneven. That's the key word.
But, and this seems crucial, people's expectations didn't change overnight, did they? That idea of shared prosperity, of living like your neighbors.
That's the critical disconnect. The economic reality started to shift, become less equal, less certain. But the cultural expectation, forged in those post-war decades, the expectation that your life shouldn't be dramatically different from the people up the income ladder that persisted.
That idea that, the 50th percentile and the 90th percentile shouldn't live in totally different worlds.
Precisely. That expectation